If you want to trade like the pros, you need to understand fair value gaps. In this video, we'll break down how these powerful smart money concepts work. Mastering this can give you a serious edge in the market. We'll break down fair value gaps, what they are, why they matter, and how to identify them both manually and automatically. Plus, we'll walk through a simple trading strategy to help you trade them effectively. At the end, we'll apply what we've learned with real chart examples so you can see these concepts in action. So what is a fair value gap? Imagine having the ability to spot hidden trading opportunities that most traders miss, all while keeping your strategy simple and effective. In the financial markets, where every decision can mean profit or loss, having an edge is everything. That's where the fair value gap trading strategy comes in. Used by smart price action traders, this method is surprisingly simple, yet incredibly powerful, helping you navigate the markets with confidence and precision. A fair value gap, also known as a market imbalance, occurs when strong buying or selling pressure causes a rapid price movement, leaving a gap in the market. These gaps are key to the fair value gap strategy, as the market tends to correct itself by revisiting these price levels before continuing its trend. Traders use fair value gaps to identify potential entry and exit points as they act as markers on the chart. The concept is based on a three-candlestick formation, where a sudden price surge creates an imbalance, leaving a gap between the first and last candle's wicks. There are different ways to trade fair value gaps. Personally, I prefer to place my entry within the gap and position my stop loss below it to protect against any sudden moves. Regarding take profit, I leave it up to you to decide, as long as it aligns with your risk management strategy. Before we jump into the practice part, where you get to spot the fair value gaps yourself, let's examine two examples from the chart. First, we begin with a buy setup. Step 1. Identify a strong candle. Look for a bullish candle with a long body, around 70% of the total candle length, and relatively small wicks. This indicates a strong move in one direction. Step 2. Check for incomplete overlap. The two candles immediately before and after the strong candle should not completely overlap its body. There should be a gap between the high and low of these candles and the strong candle's body. Step 3. Define the fair value gap. The fair value gap is the price range between the high of the candle 1 and the low of the candle 3. This gap represents an area where price moved quickly, leaving unfilled orders, creating a potential zone for price to return to in the future. Now let's look at a sell setup. The process remains the same. First, try to identify a strong sell candle. Look for a bearish candle with a long body, making up about 70% of its total length, and relatively small wicks. This signals strong downward move. 2. Check for incomplete overlap. The two candles preceding and following the strong sell candle should not completely overlap its body. There should be a clear gap between their high and low points and the body of the main bearish candle. Step 3. Define the fair value gap. The fair value gap in this case is the price range between the high of the third candle and the low of the first one. The price would tend to touch the gap before continuing its downtrend move and is definitely a solid point to place the sale trade, like the case here. Before I share a simple fair value gap trading strategy and jump into the practice session, let me show you how to do it fully automatically. First, open your TradingView chart. It's important to use a higher time frame, starting from 1 hour and above, as fair value gaps on lower time frames, like the 5-minute chart, are not as solid or reliable. Next, click on Indicators and type Fair Value Gap in the search box. You'll see multiple options, but my favorite is Fair Value Gap by Lux Algo. Simply double-click it and it will be added to your chart. No need to adjust any settings. I usually stick with the default ones. All fair value gaps will automatically appear on the chart, bullish gaps in green and bearish in red. This saves a lot of time and makes trading much more efficient. Now, let me share my favorite fair value gap trading strategy that you can use to trade Forex, crypto, or basically any market. Relying solely on fair value gaps is not a good idea, as they can produce false signals. A trader's goal is to increase the probability of being on the right side of the market. The more confirmations you use, the stronger your setup and the higher the chances of hitting your take profit. To improve accuracy, here's what I would do. First, add the 200 moving average to the chart. There are different variations of this indicator, but personally, I like to stick with the exponential moving average. I usually mark it in red so it's easy to spot. This indicator helps determine whether the market is in an uptrend or downtrend. Basically, when the price is above the 200 moving average, we should only look for buy entries. And when the price is below it, we would only consider sell signals. Here's an example. We can see that the price is currently above the 200 exponential moving average, signaling an uptrend where we should only look for buy entries. On top of that, a bullish fair value gap has formed right here, providing us with a potential trade setup. Based on this, I will place my buy order at this level, which will be triggered when the price pulls back to test the fair value gap. A few hours later, the price touched the fair value gap, formed a bullish hammer, and our buy order was activated. As expected, the price continued its upward rally and successfully hit our take profit. Now, before we jump into the practice session, let's take a look at a sell example. I'm sure you've got the logic by now. Here, we can see that the price is below the 200 exponential moving average, confirming that the market is in a downtrend, meaning we should only consider sell entries. Additionally, a clear bearish fair value gap has formed, presenting us with a solid trade opportunity. With that in mind, I'll place my sell order at this level, which will be triggered once the price pulls back to test the fair value gap. We can say that the fair value gap would act as a magnet, pulling up the price and giving us an opportunity to enter the market at a better price level. A few hours later, the price tapped into the fair value gap, formed a long wick bearish candle, and our sell order was activated. As expected, the price continued its downward move and successfully hit our take profit. Now, let's dive into the practice session. I'll show you the chart, and it's your turn to spot the fair value gaps on your own. You'll have 5 seconds for each one. Let's see how sharp your eyes are. There will be a total of 10 fair value gaps. Drop a comment below and let us know how many you managed to spot. The perfect score is 10 out of 10. Can you get them all? But before we begin, don't forget to hit the thumbs up and subscribe to the channel so you never miss out on our future videos. Let's get started. I hope you score a perfect 10 today and learned how to trade Forex with the fair value gap. Don't forget to hit the thumbs up and subscribe for more powerful trading tutorials. A huge shout out to our paid members. Your support means the world to us and keeps us motivated to create even more valuable content. Happy trading, and see you in the next video.